Hello and welcome to our California real estate update for March 2025. We're going to be looking at the latest monthly print from the California Association of Realtors. And guys, the headline this month is positive because we're actually beginning to see some metrics that resemble pre-pandemic numbers. And that's amazing. It's been a wild couple of years for real estate in California. I mean, across the country, but especially in California. And the big question on everyone's mind is, when are things going to get back to normal? And we've had to deal with the new normal and the new abnormal and all sorts of craziness. But it looks like we might actually be approaching something close to almost at a point of normalcy, kind of. Okay, we're not quite back all the way, but some metrics are looking really good. Let's get right into it. I'm Jon Schwartz, California's 1% homebuyer agent. This channel is for California homebuyers. Stay tuned and subscribe for local market updates, statewide market updates, California real estate news that you need to know. Like, did you know about the California Realtor scam that's been grifting hundreds of millions of dollars off of California homebuyers? I'll post a video link right up there, so check it out. I'll put the link in the description too. Maybe after we get through this data, you'll want to check that out. But without further ado, let's get into this month's California real estate update market data. And here we have it, the latest print from the California Association of Realtors. We're going to start at the statewide level, and don't worry, we'll get down to regional and county level data as well. But here are the headlines. Existing home sales actually fell 1.9% year over year to an annualized rate of sale of 254,000 homes. Median sale price is up 6.3% year over year. And in California right now, we have a median sale price of almost $839,000. Median days on market is up 9.4% year over year to 35 days. And I'm saving the best for last, guys. The unsold inventory index, also known as months of supply, is up 28% year over year to a very healthy 4.1 months of supply on the market. Now, those disingenuous crash bros out there are going to point to this and say, oh my gosh, inventory is soaring. The California market is going to be crashing. We're seeing the beginning of it. You can believe them if you want, but it's a load of BS. This is actually an excellent and healthy number to be at in California, 4.1 months of supply. And as we'll see in further data, it is a welcome sign that we've gotten up to 4.1 months of supply. Let's dig into regional numbers and see how they stack up against the statewide averages. And we start here in Southern California. This area actually makes up about half of the whole California housing market. So these stats are important. Existing home sales here is actually up 1.8% year over year, as opposed to down 1.9% statewide. Pricing is up 7.7%, so that's a little higher than the statewide average. Southern California has a median existing home price of $950,500. The unsold inventory index is right on statewide target at 4.1 months. Median days on market is a day slower than the statewide average at 36 days, and the sale price to list price ratio in Southern California is 98.7%. And now moving into the Central Coast, we actually have a big jump in existing home sales, positive 8.3% year over year, and an even bigger jump in home prices, 14.5% growth year over year to a median home price in the Central Coast of $1,060,000. The unsold inventory index is at 4.1 months, just like statewide. We have a speedy market in the Central Coast at 32 days for median days on market, and our sale price to list price ratio is actually quite low at 92.7%. Honestly, I'm very surprised to see such a low sale price to list price ratio and such a large growth in home prices. And moving up now to the Central Valley, we have a modest 1.1 growth in existing home sales, a pretty healthy 4.3% growth in prices to a median price now in the Central Valley of $480,000. Unsold inventory index is a little low, or I should say lower than the statewide average at 3.8 months. Median days on market is a hair faster at 34 days, and the sale price to list price ratio is 98.5. In the Bay Area, we have just a hair of sales growth at 0.2%. Price growth has been pretty modest at 2.3% year over year to a new median sale price in the Bay Area of $1.125 million. Inventory, of course, as it usually is lower than the statewide average at 3.2 months. Median days on market is pretty tight at 29 days, and the sale price to list price ratio is 100%. The sale price to list price ratio in the Bay Area is pretty much always 100%. The Bay Area is for sure the most competitive market in California, and by that measure, one of the most competitive markets in the entire country. And finally, we get up to the far north, where home sales crashed. Existing home sales are down 11% year over year. Prices actually grew quite a bit, 10.7% to a new median home price of $400,000. There's plenty of inventory, 6 months. There is a very slow market up there, 50 days. But the sale to list price ratio is actually not the lowest in California at 96.8%. And now when we look at sales by region, we see something pretty interesting. If we look at the year-over-year sales growth by region, we see that sales growth was actually positive in all of the state except the other counties and the far north, right? This part of the graph is positive. This part of the graph is negative. And when we look at our handy-dandy pie chart, we see that other counties and the far north only accounts for 8% of the California housing market. So let me clean this up. 8% of the market is negative sales growth over last year. 92% of the market is positive sales growth over last year. But when you average it all together, you still end up with negative 1.9% sales growth over the past year. You're still in the red. We're still, as a state, negative. Where we saw the most sales growth, the Central Coast, is a relatively tiny part of the state, only 4% of the market. Meanwhile, Southern California, the Bay Area, and Central Valley, which account for the lion's share, almost all of the California housing market, saw pretty anemic growth, 1.8%, 0.2, 1.1. So it makes sense, but it's interesting, right? That the fact that the headline is sales shrink in California, but really that's only true for 8% of the state. Everywhere else taken together saw sales growth. Got to dig into the data, kids. It's important to go into the subtabs so you really understand what's happening. If we break down sales by price point, we also get some pretty startling information. We can cut this graph in half right here. Homes up to $750,000 all saw negative sales growth over the past year, whereas homes $750,000 and more all saw positive sales growth. Now, it's worth remembering that the median price of a home in California right now is $838,000. 750 isn't quite 838, but it's roughly close. In other words, below median price home sales in California shrunk in the past year, and above median sale price home sales in California grew in the past year. So not only are home sales declining only in a small part of the state, but also home sales are declining only in the low half of the market. Also interesting, if we look at the other graph on this page, this is the share of the market by price segment. The lowest price segment of the California housing market shrunk by 3 percentage points. The $500,000 to $1 million price point shrunk by 1 percentage point. And $1 million plus homes is the only of these price segments that actually grew in terms of market share by 4 percentage points. So you can actually put these two metrics together and say that homes that cost less than $1 million in California shrunk in market share from 73% of the market down to 69% of the market. And homes that cost more than $1 million grew in market share from 27% of the market to 31% of the market. This is a trend we've been seeing since the pandemic, and we've especially been seeing it in the last year, just the lopsidedness of the California market. The high end of the market is getting more expensive and is becoming a larger share of the market. And this graph really demonstrates that point. This graph shows year-over-year price growth for different price segments. The purple lines are the $2 million plus homes. And as you can see, we have positive price growth every single month in the $2 million plus price point. The green line is homes that cost $1 million to $2 million. The blue lines are homes that cost $750,000 to $1 million, etc. down the line. And looking back over the past 24 months, what we see is that homes that cost $2 million really outsell everything else every single month. No month did homes over $2 million see any negative sales growth, which means sales contraction. Second to the homes that cost $2 million or more are the homes in the $1 million to $2 million price point, which only saw 1 month of contraction over the past 2 years. And then all the price points below $1 million have seen lots of price contraction over the past 2 years. And even when they're growing, they're trailing behind the $1 million plus and the $2 million plus homes. This graph really demonstrates that point. This graph shows the market share of homes that cost under $500,000 compared to homes that cost over $1 million. And nicely, we have this COVID-19 breakout period marked. So pre-pandemic, homes that cost less than $500,000 consistently were about 47% of the California housing market. And homes that cost over $1 million consistently were about 17% of the California housing market. As soon as the pandemic hit, these numbers inverted. And we've actually had this oscillating around 30% ever since. Now, I've been asking the past couple months, when are these numbers going to renormalize? They're probably not going to renormalize to the levels we saw pre-pandemic. Obviously, the number of homes selling for less than $500,000 is permanently decreased, and the number of homes selling for $1 million or more is permanently increased. But what I've been wondering recently is if this oscillating around the 30% line is going to be the norm indefinitely. This is one of those California trends that it's interesting. At least to me, it's interesting. And we're going to keep watching it month in and month out in the years ahead. Now we're going back to our statewide sales numbers. And as noted previously, home sales this month were at an annualized rate of 250,000 homes sold. That's us down here. Really, we're at Great Recession levels of home sales. I mean, home sales are still drastically depressed from the 400,000 home sales per year average that we had in the pre-pandemic era. It's also worth noting in this graph that we had a sharp decline from last month. Hopefully, this decline doesn't continue through the year. You can see that after the highs of 2021, when rates doubled in 2022, home sales collapsed. We kind of reached a bottoming out at the end of 2023, and 2024 bounced back a little bit. Hopefully this bounce back continues until we can get some sales numbers closer to that pre-pandemic 400,000 annual average. This is another great chart that demonstrates how sales have fluctuated since the pandemic. The pandemic obviously was right around here. Pre-pandemic, we had a rather narrow band of sales growth and sales contraction from year to year. This was our normal healthy market. The pandemic struck in March 2020 and sales plummeted. Then the Fed started cutting rates and sales spiked. And then the Fed started raising rates and sales plummeted again. And what's worth noting on this graph is this is the negative impact of the pandemic. It's like a little upside down iceberg in the water. This is the impact of interest rates doubling. And you can see here clearly that the impact of interest rates doubling is far greater than the impact of the pandemic itself. Finally, somewhere toward the end of 2023, we got used to these new rates, and we have mostly positive numbers for sales growth through 2024 until this past month, where we had a 10% decline to a year-over-year sales contraction of 1.9%. And again, hopefully this is a momentary passing sales contraction and doesn't suggest that 2025's sales numbers are going to be depressed like 2023's and 2022's sales numbers. Unfortunately, this chart suggests that our depressed sales numbers may continue for a couple months longer. This is a graph of pending sales. Now, pending sales is a leading indicator for homes sold. A home goes pending about a month before it becomes a home sold because a home is marked as pending when it goes into contract and the escrow process starts. The escrow process typically takes 30 days, and at the end of 30 days, the transaction completes and the home is marked as a home sold. So pending sales tends to lead homes sold by about a month. And right now, pending sales has shrunk year over year by 6.4%. So keep in mind, with homes sold down 1.9%, but this month's pending sales down 6.4%, it means we should see an even bigger drop-off in homes sold next month. That's not great news. And I know at the beginning of this video, I teased that there was some really promising news. Don't worry, we're going to get there. Now we're looking at pricing. And this is a funny headline. The California median home price grew for the 19th month in a row. But you can see, 19 months is almost 2 years. You can see over the past 2 years, this price has actually fluctuated. So the California median home price has not literally grown for 19 months in a row. What they mean is the year over year gain has been positive for 19 months in a row. There's an annual cycle to home prices. You see it pre-pandemic, post-pandemic, and that's part of the natural fluctuations. And continuing to look at price growth, we've now broken down the market into percentiles. We have the 20% least expensive homes on the California market, the 20% most expensive homes on the California market, and the quintiles in between. These groups are called quintiles. A quintile is a fifth of a segment. And not surprisingly, the highest median price gains were in the highest quintile, where we saw median price gains of 14.1%. And if we break down the highest quintile into even smaller groups, this is the 80 to 85th percentile of housing by price, 86 to 90, 91 to 95, and 96 to 100, we see that median price growth only escalates as you get into more and more expensive homes, such that the most expensive 5% of homes in California saw the highest median price growth of 20.3%. And what I really like about this graph is that quintiles are not bound by price. When you have price bands, 750,000 to $1 million, if homes get more expensive, they fall into the next price band. But because these are quintiles, it's like the cheapest 20%, the next cheapest 20%, the middle 20%, the 20% more expensive than that, and the 20% most expensive homes in California. Because we have, I don't know how to describe it, flexible quintiles, we get a really good reflection of how different parts of the market are moving. And what we see is more expensive homes are getting more expensive. And the share of homes sold above asking price fell to a 23-month low. That's good news for California home buyers. We're now at 30.3% of homes in California selling below asking price. A year ago, we were at 33.2%. And of course, the high point we reached in California was April of 2022, when 72.9% of homes sold above asking price. That was an intense period in the history of California real estate. I'm glad we're back down to 30%, which is, in line with our pre-pandemic numbers. Now we're looking at homes sold above asking price by county. And as you can see, only 4 counties had more than 50% of homes selling above asking price. Of course, those counties are Santa Clara, San Francisco, San Mateo, and Alameda. In other words, the Bay Area, the toughest market in California. And on the other end of the scale, we have 4 counties where effectively no homes sold above asking price, and that is Del Norte, Glen, Mariposa, and Trinity. Now we're looking at list price versus sale price, and these are 2 metrics that are in an endless tango, pulling each other either up or down. And as you can see, for the past couple months, sale price in red has been ahead of list price in blue. By ahead, I mean higher. And what this indicates is a demand-driven market. Agents are not pricing homes as high as they're selling. Instead, buyers are coming in and bidding up prices so that, again, sales price is above list price. This is what a high demand winter looks like, and of course will lead to an early start to the spring home buying season. And indeed, that's what I'm seeing in the local market updates that I'm doing. I post 3 local California market updates per week. Check my channel to see if I'm following your local market, and subscribe if I am. Also subscribe if I'm not, because I put up a lot of statewide stuff as well. Now we're looking at price growth versus mortgage payment growth. Mortgage payment growth accelerates as mortgage rates rise. And what we saw this past month is that price growth, the blue line, grew 6.3% statewide, as we've already seen, but the growth of mortgage payments, the red line, grew 9.9%. So the actual impact for home buyers of both price changes and rate changes has been worse than the impact of just price changes. Fortunately, though, as I record this video, we've actually seen mortgage rates sliding down for the past month to solidly under 7%. So hopefully next month we'll see a reversal of this trend, that the increase in mortgage payments for California homebuyers will actually be smaller than whatever increase in pricing we see. All right, gang, now we're looking at inventory, and this is a great headline. Inventory jumped to the highest level since mid-2020. Now, technically, mid-2020 is post-pandemic, but as you can see, here we are at 4.1 months of supply, which is way above the terrible 2021 period, also above the terrible 2023 period, also above the improving 2024 period. And guys, that's right. We're beginning to see metrics that are getting back to pre-pandemic norms. Pre-pandemic, supply levels hovered all over the place, north and south of 4%. Now, being at 4.1% in January, that's not a colossal win. It's not like the war is over, but it is a good battle to win. This graph is looking at total active listings by month. Right now, we can look at this January chart here. And what we see is that this January's total active inventory is towering over last year, the year before that, 2022, and 2021. Now we're still a little south of 2020 and 2018, well south of 2019, but you can see the market improvement over the last 4 post-pandemic years compared to this year. Rejoice. Active listings are back, baby. And if we look at active listings by region, we can see that listings are up across the board. The blue bar is last January. The yellow bar is this January. We have big gains in the Bay Area, in Southern California, and the Central Valley. And this is something to celebrate for California homebuyers, for all of California. This graph is now comparing the growth or contraction in sales to the growth in active listings per California region. And you can see across the board, we have active listings grossly outpacing sales. So in the Central Coast, sales grew 8.3%, but active listings grew 33.7%. Let's hop over to the Bay Area, where sales barely grew, just 0.2%, but active listings are up 63%. Or Southern California, where sales are up 1.8%, but active listings is up 49.8%. This is why inventory, measured in months of supply, has shot up this month. Listings have really outpaced sales. That means more inventory coming to market. It means more inventory. It means a healthier California housing market. Now we're looking at inventory growth by county, and the housing supply, which is another way of saying the number of active listings, increased in all but one county, that county being Lassen County. You'll see right next to Lassen County, the 2 counties that grew the least in terms of active listings are both in the Bay Area, with San Francisco County and San Mateo County. But interestingly, Alameda County, which is also right in the Bay Area, has the second highest level of listing growth at about, what would you call that, maybe 118% more listings than the same period last year. So it's great to see listings coming back, at least to some part of the Bay Area. So with listings up and sales down, the unsold inventory index rises to its highest level in nearly 5 years. We've looked at this metric already, but I just want to emphasize the point. Here we are in January 2025 with 4.1 months of supply on the market. That's more supply than we had in January 2020, admittedly less supply than we had in January 2019. But come on, we're right in the middle here. I mean, this is a pre-pandemic number, guys. Inventory, you could say, is back to pre-pandemic levels. Now, we'll have to sustain this to actually be able to celebrate this, but this is a great sign. This graph is looking at unsold inventory across the major California regions. The yellow line, of course, is the Bay Area. The gray line is Southern California. The blue line is the Central Valley. And what I want to show you is the level of unsold inventory in the Bay Area, which is here, is very much back to the norms that we saw pre-pandemic. Definitely in that range. The level of unsold inventory for the Central Valley, which is the blue line here, is also, I think you can say, solidly within its pre-pandemic range. Remember, January is a time when unsold inventory is very high. So we kind of want to look at the peaks. Where does this number compare to these peaks? And as you can see, it is right in range with these peaks. However, for SoCal, the image is not quite as bright. SoCal is the gray line. This is where we are right here in January 2025. But if we look at pre-pandemic peaks, we see that we're still kind of south of where we typically are in January. So overall, the inventory picture is really good. In the Bay Area and the Central Valley, it is really good. In SoCal specifically, it's not quite as good as in other parts of the state. We're still not quite back to pre-pandemic levels of inventory. Now we're looking at the median days on market, which right now, as we mentioned earlier, is 35 days, which is actually quite good. I mean, that's, kind of in our normal pre-pandemic range. Back in 2021, the market was fiercely competitive and fast, and median days on market was more around 10 to 15. So this is another metric that suggests that we're kind of getting back to a pre-pandemic vibe. And days on market is very much a vibes-based metric. I mean, it's not a vibes-based metric. It is a mathematical numbers-based metric, but median days on market tracks how fast the market is moving. It's a great indicator of competitiveness, just how fierce the market is. And so it's really nice to see that this metric that you could say measures fierceness is back to a pre-pandemic range. And now we're looking at sale price to list price ratio, which is another metric of fierceness and competitiveness. When this number is at 100% or more, it means that homes are selling for their list prices or higher. And when this number is below 100%, it means that homes are selling below list price. Now, statewide, the sale to list ratio is 98.6%. But when we break down the market by, what's that word we learned? By quintiles. I just wrote quintiles immediately behind me. Let me move. Quintiles, we see that the bottom 60% of the market has a 100% sale to list ratio. The 60 to 80th percentage of the market is above median at 99.7% sale to list ratio, and only the top quintile is below median at 98.2% sale to list ratio. And of course, if you break down the top quintile even further, you see that as homes get more expensive, the sale to list price ratio goes down further. What's this telling us? Well, what it's telling us is if you're buying a median or less expensive home in California, don't expect a discount. You're going to be paying list price. If you're above median, you might get a slight discount off list price, but it's only really in the top 20% of homes by price that you're actually going to see something that looks like the statewide median. That's honestly bad news for your everyday California homebuyer. So is the California Realtor scam that's grifting hundreds of millions of dollars from California homebuyers every year. I've exposed it. Check out this video and protect yourself, and subscribe to the channel for more California homebuyer videos.